Good afternoon, everybody, and welcome for this session. Our theme is the patterns of disruption and market value creation. And I am joined by John Hagel, who is the co-chair of Deloitte Center of the Edge, and who's also the author of several books on how to deploy information technology to transform the business. And next to John is Bill Ribaudo, who is the national partner for Deloitte, and who is also the dean for the future, or the next generation CFO Academy. So welcome, gentlemen. Maybe, John, you can start with give us your perspective on what the patterns of disruption are.
Sure. It's great to be able to spend some time with you this afternoon. I was thrilled when I saw the theme for the conference here, the power of patterns, because it resonated so much with a research project that we've been pursuing for almost a year now at the Center for the Edge, which was with admittedly a fair amount of ambivalence. We took on the topic of disruption, and in particular we were focused on the notion of patterns of disruption. And part of the reason we were so nervous about taking this on is that it's a topic that has been discussed ad nauseum all over the place. Disruption. I mean, it's in every business publication, every technology publication you can think of, and yet the term is used so loosely that anything that's new or different becomes disruptive. And I think that it's created a fair amount of backlash, at least among the executives that I deal with, in terms of oh God, we're going to talk about disruption again. There's going to be no insight from this. We're just going to try to raise fear and anxiety, and we won't have anything to show for it. And so what we were trying to do, we had, first of all, a sense that disruption, despite its overuse and the loose use of it, is still very relevant. I mean, some of the research that we've done at the Center for the Edge is looking at topple rates of companies that manage to get into the top quartile of performance, financial performance, and how long they're able to stay in that top quartile. And the period of leadership is shrinking significantly over the past several decades. So we do have a sense there is disruption going on, and there's an opportunity to help executives to really understand what is disruption and perhaps even anticipate when and how disruption might occur in their markets or industries. So we took on, first of all, the task of defining disruption, at least in a way that we thought was a little more contained and helpful. And our focus in terms of disruption was some new approach to a market or industry that unseats the leading incumbents, that actually displaces them. They're no longer the leaders in that market or industry. So it's a pretty high bar. It's not just that you cause them pain or suffering, it's that they end their leadership position. And we focused on, well, why would you be able to displace these leaders? And we ended up focusing on 3 different elements that could contribute to this disruption. And 2 of them, at least, are economic. One is a notion of a new approach that renders a major portion of the asset base of the leaders irrelevant. They basically have to write off a significant portion of their assets. That's a very difficult thing for leaders to do. So typically they'll do everything they can to postpone or deny that that's a necessity. The second element is a notion of being able to cannibalize significant revenue and profit streams that the leaders depend on for their economic survival. And again, that's something that's very difficult for leaders to acknowledge that that's happening until it's too late. And then there's a third element, which is more psychological or mindset, but it's a new approach that challenges the core assumptions of how business is done in a particular market or industry. In ways, the core assumptions often aren't even articulated or stated. They're just taken for granted. It's the way the business operates. And so a new approach that challenges those core assumptions can be disruptive. And particularly if you can combine two or more of those three elements, you have the potential to really unseat the incumbents in a particular market or industry. And what we were focused on was, okay, if that's disruption, there are a lot of disruptions that are going to be one-off, truly one-off. They will hit a particular market or industry, they'll disrupt the leaders, they'll unseat the leaders, and that's it. But our hypothesis was actually that over time there are likely to be certain patterns of disruption where it will hit more than one market, but not all markets. And so if we could articulate what is that pattern and what makes it so disruptive, that could be very helpful, particularly if you can also articulate what are the conditions in markets that would make them vulnerable to that particular pattern of disruption. So that was really our focus and genesis for the work. And I'll resist the temptation. We came up with 9 different patterns of disruption. Happy to share that in more detail, and we'll be publishing the research in about a month, so this is kind of a preview. But I'll just quickly go through one example of the pattern of disruption that we've come up with, and it's the notion of usage-based pricing. It's a particular form of disruption that focuses on challenging the pricing model in a market or industry, where typically in the past, in the traditional industry, there's a fixed upfront price that you pay for a product or service. And the opportunity is to create a pricing model where in fact it's performance or usage-based pricing. And that can be extremely challenging to leading incumbents that depend on that large fixed upfront price. And it's challenging because it cannibalizes key revenue streams, profit streams, and it also challenges key assumptions about the business. Of course, the customer would want to own the product versus just pay for usage of the product. Why would they want to do that? Some examples just to illustrate, and we talked briefly about them earlier. One was the notion of infrastructure as a service, coming in and challenging the traditional pricing model for servers in the enterprise, where you had to buy a server up front, you paid a fairly large price for it, and then you had to deal with the utilization issues over time. So I think that that's the kind of disruption that we're focused on. We believe that particular form of disruption will hit a number of different markets or industries over time, but not all. 2 industries that I would highlight that we think are vulnerable to that pattern of disruption. One is the automotive industry, and the other is the insurance industry. So just as an illustration, but we think it can be very helpful to executives in order to anticipate what particular forms of disruption is my market or industry likely to be most vulnerable to, and start to take action to address that potential disruption.
Thank you, John. Bill, your research is more about the market value creation. Can you give your perspective?
Sure. So, if you think about the fear of disruption, that, I think, by itself is a good enough motivator for corporations to rethink their business models. But putting that aside, there's another reason companies should look at their business models, and that is for the opportunity for value creation. I've been studying value creation, how value has migrated for 20 years. And a little over a year ago, we went through a study that we recently completed that looked at the correlation of the value that investors were willing to pay companies based on their business model. And so our viewpoint was much more not looking at a traditional model of industry verticals, or you may say SIC codes, but it was more looking through the lens of the different business models. And what we found in a nutshell is that, and it's rather intuitive, but the research proved it out, is that there is higher value for people or companies that use today's technologies. And the more that you're using today's technologies as your business, which I differentiate between as your business and in the business, right? Companies that use technologies in their business help their business, but it is not the business. So as you move to technology as the business, and you move closer to the customer or the crowd, and you move away from tangible physical assets, the more value Wall Street will give you. Now, everybody today, just like John said around disruption, everybody today talks just as much about digital, right? Be digital, go digital. Often it's not articulated why, in the grand scheme of an investor, as a board, at the CEO level, the CFO level, those that care about the value of the business, not necessarily its efficiency, people have not answered the question why. And what our research showed is a bit of that answer, why you would want to migrate your business model. Let me give you an idea of what I mean. Let's see if we go back one. Okay. What our research showed, and you can try to complicate it, but it's not worth it. There are only 4 business models in existence. You either bottom left make things, bottom right provide a service, top left create intellectual capital or property, or top right build platforms and networks. Now, the bottom 2 are physical models. Right? The bottom left one is, if I'm going to sell an item, I have to make an item. On the bottom right, if I'm in the service business like my business is, if I want to sell an hour, I have to buy an hour. Of course, I buy them in 2,000-hour increments. Those are both physical business models that scale only at a certain rate. When you cross what I would call as the digital divide, you then move to more scalable business models that have higher value. And what we found was that as you moved from one business model to another, the value that Wall Street would pay was exponential. That if you made things, your value was 1 times revenue. So these are revenue multipliers. Now, there's variability inside of each one of these boxes, but to keep it simple, you're worth about 1 times revenue. If you provide a service, you're worth about 2 times revenue. Same revenues, possibly same profits, double the valuation. You cross the divide, it goes from 2 to 4. So if you are a biotechnology company, if you're inventing, if you're creating software, anything that's IP-based, and let me just differentiate, I'm not talking about the manufacturing of drugs. That has a different value, that's bottom left. But the invention is top left, 4 times revenue. Or if you move into what would be some of the traditional companies, like the big credit card companies, right? They've created a platform that retailers and consumers trade on. If you're in that platform business, again, it's double or 8 times revenue. Now, if you climbed behind the research, what you'd find is that the bottom left is 1 to 2, the bottom right is 2 to 3, 4 to 5, 8 to 15, and beyond. So very strong correlation to the type of business model that someone uses. And in fact, we've done the research that can take 2 companies in the same industry, providing kind of the same thing, but using 2 different business models, both about the same size and both delivering the same pre-tax profits. But with 2 different business models, their valuation is a difference of $100 billion in one example. $100 billion. Now, there's another way to think about this. I would argue that in the grand scheme of the world and in business, one thing has never changed. Companies are put in business in order to create a model that serves customers as best they can and provides a return or a profit. However, what has changed over the years is the technology that is available for them to use. And so I have put together this model that says, okay, there have been 4, I'll call them great economic revolutions. We all know this, right? And so when we came out of the agrarian age and we created the industrial revolution, there was technologies at the time. And companies used those technologies in order to increase productivity. But we all know that that was a physical ownership model. Buy the land, build the building, install the equipment, fill it with inventory, put all of the employees in. Owned, 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 and the way that you made money was production efficiency. In about the 70s, many of the industrial companies determined that we could make as much, if not more, by servicing that which we built and sold. And the services model was a lower total investment and had higher growth, but still largely physical because it takes physical people in order to serve that. Now, we all know come the 1990s with the information revolution or the software revolution where, again, value shifted. It moved from hard to soft, from tangible to intangible. And one of the best ways to view that is, where was all the wealth being created? Whose pictures were on the covers of all the magazines? The software guys. Spin forward to what I would argue is maybe 2010, which would be the beginning, I would argue as well, of the network revolution, where again now value has shifted from merely just intangible assets, but essentially to the crowd and the ability to harness the crowd. And again, whose pictures are on the covers of all the magazines? Who are the billionaires post-2010? It's all the network guys. Now, the investors figured this out. This is something you all know, but again, it's interesting when you put the facts behind it. In 1975, if you took the entire value of the S&P 500, 83% of it, the blue, was on the books of corporate America. I mean, we kind of know that. Think about it for yourself. What's your personal net worth? My assets minus my liabilities. Have you ever valued yourself with, what's up here? But the accountants haven't kind of gotten there yet for us, right? So if you go back to 1975, assets kind of equaled the value of a company. If you went back further, it'd be even a higher ratio. But look what happened in 1995 with the advent of the information revolution and then where it's moved since. Only 20% of the value of the S&P 500 sits on the books of corporate America, which are primarily tangible assets. But the investors have figured this out, so the gap between book value and market value has changed dramatically as the technology companies have come in to the S&P 500. Maybe we'll get to it in the Q&A, Marcel, but maybe I'll put out one other thought, maybe as a little bit of a tease, because you can pull back the onion on this one a lot. And we can get into capital finance, balance sheets, and I can even get into, and we might get into mental models. But think about de-verticalizing any industry and separate in that industry those businesses that deal with tangible assets versus intangible assets, and those businesses that deal close to the customer or far from the customer. And let's just use one as an example, which would be the hospitality industry. Right? There is the owner of the hotel, the building. And then there is the operating business. Then there is the brand. And then there is the customer loyalty program. Each one of those fits into one of those models. Turn it back to you, Marcel.
Thank you. Thank you, Bill. If there are any questions, please line up behind the mics. John, you have been talking about patterns that will hit some markets but not all. Are there disruptions that hit all markets, and if so, what are they?
Yeah, well, at least based on the work we've done, we've ended up focusing on the long-term forces that are reshaping the global business economy, and we would argue there are certain disruptions that will be universal, that will hit virtually every market or industry, and have the potential at least to topple the leaders in those markets and industries. And if you're interested, we've written a lot on what we call the big shift, but I would just highlight two disruptions. One is a shift from push-based models of resource mobilization. So you develop a forecast, you push all the people and resources to the right place at the right time to meet the forecast. That's the traditional model for resource mobilization. Increasingly, our belief is the models that will win in the future are pull-based models, where it's about drawing out people and resources when you need them and where you need them through scalable pull platforms. That's a fundamentally different approach to resource mobilization, and we think will render many leaders displace them.
Thank you. Mark?
Yeah, thanks, guys. Pretty cool. Bill, I have a question for you. In the work that we've done on looking at country GDPs, we came to the conclusion really early that we needed to look at the business model of the country and to understand their economics. And their, as Scott Foster was talking about this morning about Japan, we didn't take the old rules. We looked instead at what's the business model and are they meeting their own metrics in their own model. Japan is. From the work you just described, with company valuations increasing as the business model advanced, I would like to suggest something and hear your feedback, and that is, shouldn't we, if we're right that business models, national business models, is how we really ought to understand and value, not just companies, but countries.
Absolutely, yep.
Shouldn't we do that? Shouldn't we value country GDP based on the national business model, country by country?
I couldn't agree with you more. And it's a natural extension of some of the research that we've done, because I believe that, as I began to allude to around the accountants, and it's easy to pick on ourselves, right, because whom I work with. But if you look at that whole industry, how long the rules of accounting have been around, and therefore that parlays itself into the measurement of GDP and everything else and how we think about everything. And the reality is once somebody begins to truly understand, with research and numbers that prove it, that value doesn't exist anymore in those other assets that we've always focused on, then it requires new measurement systems. You notice that we used revenue multiplier and not a PE, right? Because PEs can fluctuate and they're susceptible to manipulation easily. As well, we also know that as you move from left to right or bottom left to top right, that companies no longer, the more digital you are, the less you trade on profit. You'll trade more on revenue and the forecast of revenue growth. But as you move more into that network space and their KPI changes to average monthly user, companies, very famous ones that we know, will have increased top line, increased bottom line with a forecast of an increase on both, but average monthly users didn't move as fast as the analysts thought, and the stock goes down. So that would imply that all of those old measurements, which now I'm taking, again, Mark, from corporate to then GDP measurements and everything else, they're outdated. They need to change. And so when you can go country by country and say, what is that national business? Are we an outsourcer? Right? We know these countries, right? Are we a body shop outsourcer? That's a business model versus invention, right? And we've always believed in the US that one of our core competencies in the type of business we should be is we went from production to service to invention. That's why we want to protect it, right? Because that has more value, but we don't necessarily measure that. Am I on the right path of where you're going?
Yeah, thank you.
Okay. Thank you, Bill. Next question.
For incumbents, is disruption simply a case of not paying attention, or is it the case that there are true discontinuities that will just pull the carpet out from under them?
I wouldn't say they're not paying attention. I would say the capacity for rationalization is infinite. And if you're a leader and hugely successful in a market or industry, the ability to dismiss what you clearly see on the horizon is very high. And I come from Silicon Valley, and so I'm genetically an optimist. I do believe that if leaders anticipate and are clear in seeing the impact of this disruption, that there are steps they can take to manage through that discontinuity and preserve their leadership position. But it is very challenging, and it starts with, again, just acknowledging that there is a disruption on the horizon.
And I think I'll add to that. I think a lot of it emanates from the leader's mental model. And we've done some, I'll say, unquantified, not overly researched, but we've done some correlation between what the leader thinks, what their mental model is, and what the value of the business is. So I can, in a jokingly way, but I can get pretty close, is you tell me what you think, and I'll tell you what your company's worth, like that. And so let's use a quick example of retailers that have tried to go digital and still argue whether the value sits in the books, and watch a public debate between a book person and a digital person. And the book person wanting to take the company and put it back to the way it was because of what they believed. And so if you have a mental model about how you build a business, which is I'm going to buy some land, build a factory, I can tell you what your business is going to be worth. If you have a mental model that says, well, it's all about the crowd, or let's go to the thermostat business. There's a very large thermostat company that's had remote-controlled thermostats for a very long period of time. But the real value was not that, but it was in the eye to the home that Nest proved.
Mm-hmm. Right. We have another question over there.
So to what extent are these valuations for IP-based businesses based not on expected market return, but expected willingness of the state to intervene to protect them, like allowing copyright and APIs, expanding patentable subject matters, or expanding protections for DRM so that it's a criminal offense to change your John Deere tractor so that you can get your soil survey data out of it instead of John Deere getting it and selling it to Monsanto? Is this a market force, or is this really the market betting that regulators will keep these companies afloat through subsidies?
So I think the way I would answer that question is Wall Street pays for the promise of future growth. Right? And so as you go through those 4 business models, you know which ones can grow faster because they're not physical and they just can expand based on the ability to maintain that platform. And so Wall Street pays for the promise of future growth. If Wall Street were to believe there were roadblocks to that and not enough protectionism, let's say around or protection of IP, then it would stunt their view of growth and therefore the value of the business. So I don't want to get into the conversation of what should and shouldn't be protected. I would just say that they pay for the promise of future growth. That's why in the example I used before, with the companies that are in the same industry, same business, but different models, you can model how much of their stock price is supported by the profits they create. And you can see wide divergence of that. And so that Wall Street will put value where they believe future profits will come, and that's when you're away from the physical assets and closer to the network.
Thank you. I think we are almost out of time for a question, but any one of you can continue this conversation. We have a hashtag #disrupt_RM, so if you want to interact with Bill or with John, please feel free. If not, thank you very much for your thoughtful insight.
Thank you.
Thank you.
Yeah.